They walk into an open house with a pre-approval letter, a clean budget, and the feeling that they finally did everything right. 2 days later, the agent calls. Someone else offered $30,000 over asking, waived inspections, and still had cash left over. That moment feels personal, like you lost to a richer, greedier person. But the problem isn't just that houses are expensive. It's that the system is built to make them expensive. Because housing stopped being priced like shelter and started being priced like a leveraged asset. Most people think the fix is simple: build more, or blame landlords, or wait for a crash. The real mechanism is more uncomfortable, because it's a loop that pulls in everyone, including ordinary buyers. Here's the mental model you can't unsee. Housing is a balloon inflated by credit, and the air pump is the mortgage market. When credit gets cheaper or easier, the balloon expands, and if the number of homes doesn't expand with it, prices do. That is why affordability can get worse, even when monthly payments look better. Act 1 is the monthly payment machine, because most buyers don't shop by price, they shop by payment. When rates fall, the same payment supports a bigger loan, and that bigger loan turns into a bigger bid. For a simple example, a $2,000 monthly payment might support roughly a $300,000 loan at around 7%, but closer to $470,000 at around 3%. Nothing about the house changed, but the buyer's bidding power did. That extra borrowing capacity doesn't stay in your pocket. It gets capitalized into the price, and the market learns to price homes as a function of credit conditions. That leads to the hidden engine: debt expansion. A mortgage is leverage, meaning a small down payment controls a large asset, so price moves feel huge to the buyer. If you put 5% down and the house rises 10%, well, equity can jump dramatically. If it falls, the pain is just as fast. Over time, the system also got better at turning mortgages into tradable products through securitization, which just means banks bundle many home loans together and sell the cash flows to investors. That plumbing increases the system's capacity to lend because the original lender gets its money back and can write more loans. And once housing debt is everywhere, policymakers fear price drops because homes become collateral under a lot of consumer spending and bank balance sheets. Now, the myth versus reality moment. Myth: low rates make homes affordable. Reality: low rates often raise prices because the market adjusts to what people can borrow, not what they wish things cost. If you doubt that, look at what happened after 2020. Rates fell hard, payments dropped, demand surged, and bidding wars became normal. Then rates rose fast, but prices didn't fall in proportion, because the system had already reset to higher price levels, and the supply of listings dried up. The balloon didn't deflate cleanly, the air pump slowed, and everything got stuck. Act 2 is the choke point. Supply, but specifically where supply is allowed. We didn't build enough homes is true, but incomplete, because it matters whether you can add homes near jobs, transit, and established neighborhoods. Single-family zoning, parking minimums, height limits, long permitting timelines, and neighborhood veto power make it hard to add homes where demand is strongest. In that world, cheaper credit doesn't create more housing quickly, it just raises bids on the same limited set of homes. Some fast-growing regions build more and absorb demand better, while constrained metros turn every rate drop into a price surge. Then there's the lock-in effect, which is the quiet reason inventory stays low. If you bought or refinanced at 3%, moving means replacing that mortgage with a 6 or 7% loan, even if the new house costs the same. So people stay put, not because they love their house, but because the mortgage is an asset they can't take with them. Fewer sellers means fewer listings, and fewer listings means buyers compete harder for what's left. That keeps prices firmer than you'd expect when rates jump, and it keeps renters waiting for a relief that doesn't arrive. Act 3 is the asset takeover. Investors, psychology, and policy feeding the same loop. Institutional investors are not the majority of homeowners nationally, but in certain neighborhoods and metros, they can be a meaningful share of buyers, and that changes bidding dynamics for starter homes. They like housing for steady rent checks, an inflation hedge, scale, and cheaper capital than most families can access. Myth: Investors are the only reason houses are unaffordable. Reality: they didn't start the fire. They pour fuel on a market already primed by easy credit and scarce supply. Speculative psychology is the rest of the fuel, because people don't buy based only on today's value. They buy based on what they think tomorrow brings. When prices only go up becomes the common story, buyers stretch, parents help with down payments, and anyone who can scrape together a mortgage feels pressure to do it now. That belief becomes self-fulfilling because higher prices create more paper wealth, and paper wealth creates political protection. Policies like the mortgage interest deduction, capital gains exclusions on primary residences in many cases, and local dependence on property taxes make rising values feel normal and falling values feel like a crisis. The system rewards appreciation, so it keeps selecting for rules that defend it. So, what would actually make housing affordable again? And affordable can mean lower prices, lower payments, higher incomes, or simply more availability. One lever is building more where jobs are, including missing middle housing, like duplexes and small apartments, plus faster permitting, because supply is the only thing that breaks bidding wars without relying on a downturn. Another lever is reducing speculative demand, with taxes or fees aimed at short-term flipping or bulk investor activity. But those rules are hard to design and easy to evade if supply stays tight. A third lever is credit reality. You can lower payments with subsidies, but if supply is fixed, subsidies often turn into higher prices. The clean ways are income growth, price declines, or more homes. A fourth lever is encouraging turnover, like making mortgages more portable. But that collides with how loans are funded and how lenders manage risk. Here's the quick timeline that makes it click. Before the 1980s, rates were higher, leverage was tighter, and price growth looked different because the air pump was weaker. In the 2000s, financial plumbing expanded credit and normalized treating homes as wealth plans. And after the crash, policy worked hard to stabilize prices. After 2020, ultra-low rates inflated the balloon quickly, then the rate shock hit, and lock-in froze the market instead of resetting it. If you remember one thing, remember this: when shelter is a leveraged asset in a market with tight supply and rising price expectations, the price is set by financing, not by need. In a world where shelter is an asset, the price isn't set by need, it's set by financing.